to be letting people in as they come in. Obviously, like people for our webinars tend to come in kind of throughout the whole process, and then we put it up on our YouTube channel after. So don't feel like you have to feverishly write down notes. It will be on our YouTube channel later this week or early next week. I had the great opportunity to meet Alice from myPocketCFO a few weeks ago. I thought kind of what she was providing in terms of CFO help for emerging brands was super valuable, and just kind of her overall knowledge in the space for a topic that I know a lot of founders struggle with. And it's very expensive for us to find solutions in this space. It's very difficult for us to like be back of the napkin CFOs ourselves when we're founders. And so I thought it would be super helpful to have kind of Alice run a webinar here for us. Not specifically kind of talking about myPocketCFO till the end, but really kind of talking about the main topics that we wanted to go through: managing revenue, managing chargebacks, things like that. So I'm going to turn it over to Alice. She's going to talk a little bit, and then we can open up to Q&A after. And yeah, Alice, you can take it from here.
Thanks, Cameron. Hi, everyone. Thanks for coming. So I guess I could start by telling you a little bit about the story of myPocketCFO, and then I will go into about I have been a CFO for the past decades. I will go into sharing some of the knowledge on what are some of the best practices to manage your finance really in a much more efficient and effective way. And then from there, we specifically, of course, build myPocketCFO platform to serve the CPG brands. Actually, I call the SMB of CPG brands. I'd be happy to showcase a few features we just launched. And I have my guest, Ash here, Ashley Nicholson. She was my first design customer. She's been with myPocketCFO for over a year, and she has been triple or 4 or 5 times her revenue since joined us. And we love each other. I would love her to share some of her experiences in terms of managing finance while you grow like crazy, right? Okay, awesome. Okay, so I would share a little bit about the story of me and myPocketCFO. So a little bit about me. I would, like I mentioned, I've been doing finance or CFO work for the last decade. I started with, I went to Wharton, obviously a finance school. And after that, I worked as associate at McKinsey, where I did a lot of, I would say, modeling, financial planning, analysis work for Fortune 500 companies. And later on, which led me to serve as the finance country head for Xerox Greater China office. And I was stationed in Shanghai for a couple of years. I grew up in an SMB family. My dad was a SMB entrepreneur, and I grew up in the food capital of China, Chengdu. So I have a passion for SMB company, have a passion for CPG brand, which led me to actually come back to the Bay Area in 2015. And I decided to work for smaller startup companies. So since then, I have been working as CFO for a number of VC-backed startups. On my sideline, I also serve as fractional CFO for a number of CPG brands. So that's pretty much, in a nutshell, my background. And it was in serving those small companies, especially CPG, working with CPG founders and owners, that made me realize that how hard it is, for you guys, for CPG founders and owners to manage your finance. On one side, your like CPG is like from get-go, even when you're so small, you're so complex, like you're omni-channel to start with. You have to sell online, offline, retailer, wholesaler, right? You have to deal with so many different channels, and there are different nuances like chargebacks. And on the other side, you have to manage a long supply chain, from getting raw material, producing the goods, inventory management, shipping management. So it's a very complex business. However, I would say we have a lot of advancement in terms of infrastructure support for you guys in the commerce side. You get lots of digital payment platforms like Shopify. But on the back end, in terms of how to manage your data, how to provide business insight to you, I feel like it was so ancient and so inefficient. Almost all the CPG brand I talked to today, they have to manually reconcile like their sales across different channels. I'm sure that's probably pretty common for you as well, right? Like, or you have to spend probably at least a couple hundred, or easily could be a couple thousand to hire a part-time person, analyst or controller, on top of a bookkeeper to reconcile all this. And because of the fractional, work in nature, those people can only work for 6 to 8 hours for you in a month, and they don't really understand your business. So that, I think, resulted in many human errors, many frictions in terms of they have to figure out from you what's the nature of the transaction. Oftentimes, they probably categorize things wrong. So 99% of the time, in my experience, when I work with small, medium brands, their accounting book is total, to be honest, is total garbage in, garbage out. We have to rebuild from scratch. That was the pain I observed, was a pain I personally experienced as well, working with startup, CPG brands. When I served as their fractional CFO, I ended up spending 70-80% of my time having to build those like a reconciliation of data from scratch manually, which was not right. Like neither a founder, owner, or a CFO should spend so much time doing just data processing. So that was the origin actually of my idea for myPocketCFO is, how can we leverage today's technology to really take away much of the heavy load, or the plumber, the aggregator's work, get the data to the business people's hands in a much easier, much more understandable way. So all we need to do as business people, as CFOs, is we talk about business insights, business intelligence. We talk about the meanings of those data right out of the gate. And we talk about what decision you should make, like which lender you should pick. When you go out pitching to a partner, pitching to a new distributor, you can say matrix with confidence. Here's my margin, here's my here's why I chose this price, right? Here's my cost of goods sold. So anyway, it was with that idea in mind, we built this platform. And before I go into more details, I would just probably start sharing with you some of the fundamentally, I would say, 4 concepts of managing your finance, right? I would say in a very, very, simple way, think of, when you think about your finance, think of 4 parameters. First one is your top line, right? Top line would be your revenue. And we know that there are so many nuances within that revenue, which I will get into more detail soon, right? But think of that. The first is your top line revenue. And second is you need to be aware of your bottom line, which is all your expenses, right? And then top line minus bottom line is your profitability. So the third parameter is always be aware of your profitability. Again, for each category, there are so many nuances. We can get into that. But at very high level, like always be conscious and be thinking about those 4 parameters: top line, bottom line, profitability. And the fourth one, I would say, is cash burn. So as a CFO, as your financial partner, I would remind, my founder and owner saying, and anytime, any day, you should have a good idea of what is your top line on a daily or at least weekly basis. What is your bottom line spending on a daily, weekly, monthly basis? What is your profitability level, on a daily, weekly, monthly basis? What's your cash burn on a daily weekly, monthly basis. If you can have a clear idea on those four, you're already probably, I would say, above 90% of the people there, because then you can go out, you can confidently say to anyone, lender, investor, say, hey, my average sales per day is, 5K, something like that. So you can, like, the number would come just like a spring, right? So those, I would say, the from the get-go, think of all, like, if nothing else, think of those four key metrics to start with. You should be aware of on a as near time basis as possible. I think today our topic is more on the top line. So I will drill down to more the granular level of top line. Okay. In order to understand your top line level, you need to, so if we break down the top line, I would break it down by, when we say top line, usually it means revenue, right? But there are many nuances to the word revenue. What's the definition of revenue? So we can break down the revenue basically into, I think for a brand seller, typically you would have a gross sales, right? Start with gross sales. Gross sales means your price, the price you're charged, customer pays you minus tax. Typically that's your gross sales. The gross sales could also be across multiple channels, could be your gross sales by Shopify, your gross sales by Amazon, your gross sales by, I know probably many of you use distributors, Kihi or Unify, right? Those typically go through, in a PO or invoice fashion. So I would categorize them as gross sales by Shopify, by Amazon, by invoice, and cash. Some of you may do, I don't know, like farmers market or those kind of like a booth. So I would just on a very high level, like your gross sales across those four different channels. And then, I know many of you, like for CPG brands, there are a bunch of charges or chargeback or fees, after the gross sales. So for Shopify, they have their fee. So you have a 1K Shopify sales, but 2 days when they pay you, it's deduct. The fee was deducted. They wouldn't pay you the full price. With Amazon, I know there are many more charges. There are fees like Shopify fees, but Amazon also charges marketing fees, which actually should be part of marketing expense, right? So that I would say gross sales, have some idea, and then fees by each different channel would be good to be aware of. And I know many of you, you use Keyhole, you use those wholesaler, you sell through independent retailers. The chargeback for retailer and wholesaler, just from my observation, is very complex and error prone. Right. But at very high level, you probably want to have a good idea what would be the chargeback in general, as a percentage of your gross sales by each channel on a, let's say, monthly or quarterly or yearly basis. That would be good. I would say a good idea you should have. Right. And then I would say the gross sales minus all kinds of fees and chargebacks would be your net sales. So that's in terms of revenue level, think of those three, I would say three metrics, right? So what's my gross sales? What's my chargeback by channel? Or like if you use just one or two really big distributors, you might want to even track specific chargeback by that distributor. That will give you a really good sense of what's the chargeback by channel or by your key distributors. And then minus that, then would be your net sales. Your net sales is really, should be your income that you report, either for tax purpose or for investor, for lender. I think they will probably be looking at that net sales number closely, right? So I would say that's kind of in a nutshell. When we talk about top line revenue, we should think of those three parameters. And then I want to throw another kind of complication is I would say that the other two concepts I want to introduce in terms of top line, I call revenue recognition, right? Is one is cash-based sales or accrual based, meaning whether it's Shopify or Amazon or your retailer, wholesaler, there is a gap between, the customer pays you and you collect the actual cash, right? So Shopify is probably the quickest. They pays you every 2 days. Amazon pays you every 2 weeks. Wholesaler, retailer is much longer cycle. They pay you, let's say, anywhere between a month and 3 months, right? So it's important because this concept then would tie back to your cash burn level. If your collection cycle, so that's another, I'm going to introduce another concept, right? Then we're talking about between accrued sales and cash-based sales, the concept would be, what's your collection cycle, right? If your accrued sales is a huge number, say, I don't know, like 10K per day, but your cash, cash revenue is really low and your collection cycle is long, saying on average, my collection cycle is 3 to 5 months, then I would say as a CFO, right, I would say maybe you would have a working capital crunch, right? Because then you have a lot of sales on reported on the book, but your cash is probably pretty low because you have not collected back. It takes 5 months to get those cash in your bank, so you cannot really utilize that cash to pay for your production, to run your inventory or for your other operating expenses. So as you see that, so within the rev rec, I call revenue recognition kind of finance management, those are some of the, I would say, key financial metrics you should be aware of. Like those are actually, they're all tied to each other, and they should be reconcilable with each other as well. So anyway, that's kind of a quick, I would say, a quick in a nutshell. On the revenue level, I would say top line, and then when we talk about how do we manage the revenue recognition under the finance part of your business, those are some of the key concepts I would recommend you to pay attention to and be aware of as closely to real time as possible. And I'm gonna pause here. And Ash, you want to have some comments or questions first, and then maybe we can ask our questions to see if they have something to say, our audience. Sorry.
Sure. Yeah, it's complicated across channels. I think the most complicated, and we're about 65% D2C, so it's actually probably less complicated for us with Shopify and Amazon, but we are embarking into retail, and we work with Unify, and we also work with Pod Foods, and it is just, there's so many chargebacks. I submitted an invoice to myPocketCFO. I just got our monthly statement from Pod Foods. There's like a $300 chargeback, which is small in comparison to our Unify chargebacks. Now I'm going line item by line item, trying to figure out, is this a marketing expense? Is this a handling fee? Is this what is this? And that's, I think, the largest challenge I feel for food and bev businesses. And we're shelf stable. I can only imagine what it's like in the frozen set. So not really much of a question, just I'm sure everyone here is it kind of feels the same way in the world of retail. And then with Unify, it's just impossible to even understand what the chargebacks are. And usually they're just coded with different numbers, and then you have to contact 20 different people to try to figure out what that code means. So that's why myPocketCFO at least makes things much more simple. But still, chargebacks are just so complicated. And Alice, you broke it down really well and nicely. And I'm taking notes myself, because I'm like, okay, this is what I need to keep in mind. This is what I need to keep in mind for this channel and this channel, but it's still so complicated. So I guess these are probably questions I'd love to hear what other founders do and how they figure out retail chargebacks and breaking down UNFI, and we're about to onboard with KE as well, what that looks like and how you classify things. And so I have a question for the group because it's just so much extra work. And do you have a team member who does that? So I'd love to just throw that out there.
Yeah, anybody can feel free to unmute themselves. I think like with like Q&A throughout, kind of like how we'll do it. For this, I think it's good. And just like realizing Alice is like a CFO that's kind of just available to answer like questions for you. So whatever the most pressing issues for you and your business, like you can feel free to kind of ask those questions in the space. Obviously, if you don't feel comfortable doing that, we won't force anybody to do that either. But if anybody does have questions kind of like that are top of mind for how they're running their business, especially when it comes to chargebacks and managing revenue, that would be super helpful. And we can dive into that there before Alice kind of goes into her solution.
I'll chime in.
Yeah.
And I'm not a business owner. I'm a client and distributor manager for a broker called Gather Brands, and we don't provide that service right now. So that's why I came on this call. But I have seen some of these chargebacks. Some of the brands ask for advice, and I've helped facilitate them going to deductions at unfi.com and the equivalent at KE. And it's important. I just know that it's important to be really meticulous about it, because you can dispute them and you can get them turned around. If you just accept whatever you're being sent, then there could be things that get on there that are mistaken. So I know other bigger brokers have a person dedicated to it. It is a service that some brokers provide, and you definitely need to pay attention. So I'm glad just to learn and just throw that out there, but happy to learn more. Thank you.
Thank you. No, that's great insight. I recently talked to a brand owner, and she specifically mentioned that that's a pain. It's really to reconcile with those detailed chargebacks, because she knows oftentimes there are mistakes, and she wants to reclaim back. So that could be a future service for sure, is even just to every time to scrub the chargeback in line item and find reclaim opportunities, right?
Well, and it's also important, even in the setup process. I think, even before you go into a distributor, it's important to really get granular with your pricing, like you said at the beginning, because some emerging brands don't understand they really need to build in room for some of these inevitable charges. So it's a good exercise to go through with newer brands.
Totally. And actually, I love your comment on that, Jen, is so we actually have a feature, but even just from business thinking perspective, is it's always good to, like when you talk to the distributors, think about what would be a good estimate of the chargeback as a percentage of your gross sales. Your pricing basically goes back to Jen's point. We actually have this feature that when you set up, so it's much easier at the get-go and the setup, you enter a estimated chargeback as percentage of the sales. And then later on, when the actual chargeback comes in, you compare the differences, the gaps. Again, we're building that to compute that for you. And then if you run that for, let's say, 3-6 months to a year, you have a pretty good idea, then what is the percentage, the chargeback on average, of this distributor, Keyhole or Unify, would have on your top line, the impact on your top line. And then based on that understanding, you can say, oh, maybe I should adjust my price higher, or I have more buffer actually to keep the low price. So that basically gives you much more insight about your pricing strategy and overall your, between the gross sale, the price and the net sales.
and this isn't really in there in the purpose of the call, but I find that a lot of young brands also, they don't necessarily figure in the freight cost before they even get to the distributor to deal with chargebacks. So all of a sudden they're like, oh my gosh, what's going on? I can't afford this. So there's a lot that goes into it.
Totally.
Beforehand.
Go ahead.
Nick, you wanna go?
Just a quick question on on contestation of chargebacks. I'm literally sitting here in front of me. I've got like 4 pages from KeHE of our POs and our shipments, and then most of the chargebacks are completely cryptic. You know, they say A in progress or something that doesn't really describe what the chargeback is associated with. Anybody have any tips or idea or feedback on how you might begin to decode?
I could look. Do you look on the portal? Have you looked on the portal for a glossary of chargeback terms?
That would be Jesse, who's also on the call and in the room.
Okay, and then my second recommendation would be to talk to your category manager and see if they can guide you. I haven't really done it so much on the KeHE side, but that's what they're there for. So I would definitely tap their experience.
Well, thank you.
And I'm actually just curious to know, like, for example, KeHE, what would be the typical chargeback percentage?
Are you asking anybody or? So for us, this is our first quarter or so with KeHE, so I don't really have that until maybe Cameron has a good sense, or somebody who's been with them for a long time.
Yeah, I mean, for us, it really varied, but I mean, it was definitely like getting into like the high single digits in terms of sometimes chargebacks we would see. So, I mean, it can definitely be pretty scary when you're like, you're not really prepared for that. Like, I think a lot of times too is like, that's when we always kind of talk about and preach here. It's like a lot of brands will open up distribution and not necessarily have like the points of distribution ready. So a lot of the chargebacks you're getting hit with is just the product sitting for too long. And so like a lot of brands will get super excited about that order that comes in from a KeHE and UNFI. And unfortunately, like if the product just sits there, they're going to just start charging you for it. So just like making sure you have like a clear distribution plan, like once you open up that DC, I tend to see as like the biggest thing. But yeah, I'm like 4 or 5 years removed from like a position that I don't envy you and Nick, like diving through that report. So I would be kind of speaking on kind of my past experience, which I don't know. I'm sure they probably increase the amount that they're taking in total. I
have a brand that's told me recently this week that she's been scouring her invoices and it could be 30% on their invoice that is taken off. And I personally, from experience thus far, say that UNFI has way more fees than KeHE. So, it's just really, they could do an overpull, which means I think what you were talking about, Cameron, it's overpull is a little vague. It could mean they ordered a lot on promo and then they sold it. So then they order more and then it's more than you anticipate, because they're doing it at the discounted price. But then there's also when it sits there, they might charge you for the space. Pod Foods as well does this. And then if it goes out of code, then you have to buy it back. And you might even have to buy it back at the wholesale price. And that's also the difference between the OIs and the MCBs. The OIs go off the price that you sell, comes off the price that's landed at a landed price, and the MCB comes off the published price.
Yeah, so maybe you can speak more to that, because like, are you guiding brands to choose like MCB over OI? Like a lot of times, like I sit away from OI because like there was no way for me to know if that actually made its way down to the retailer, where the MCBs I could actually like be able to see like how many of those were actually charged back from the consumer actually purchasing it. So like, do you tend to like steer any way one direction or the other in terms of what chargeback they're picking?
Me?
Oh, Alice.
Or I asking me.
Yeah.
I would say, so again, from finance management perspective, we're really trying to simplify the process. So understanding the actual business operations might be a lot more complex, like I saw how many pages, Nick, you showed, right? You kind of wave your packets. That's just way too complex. I think as a CFO, my advice would be, think of the finance management more as you have to strike when it comes to finance management or recording those expenses or chargeback. I would say you have to take a balanced approach in terms of how much time and resource you pour into that in getting the accurate count versus how much benefit you get out of that. So my advice always be, let's take especially for small businesses. I don't know again about your size of the business here, but typically, when we serve small businesses with like under 5 million revenue, they just don't have that many resources. I would hate to see a founder or like a business person, like a general manager type of business people spending days and weeks just trying to like read the tea leaves from Kihi or Unify and trying to claim back, let's say 30% of that, whatever 9% chargeback. So my advice in general is take more of a higher level approach when it comes to finance management. That's why I ask you to estimate the percentage. Like if on average, let's say Kihi is 9%, Unify, I don't know, 30%, right? So pick always shoot for the biggest bang per buck. And the other thing is, if it's 9%, like a bake that like you could just put on average 8 or 9% into every month of your chargeback. Actually, we have a feature for you to do that as part of your business planning or forecasting, is just bake that into your price or your overall cost structure. So that right out of the gate, for every product you sell, let's say through Kihi, and 10% of the margin will be gone. 9% of the margin will be gone. So you have to plan that ahead of the time and then come up with a price that's sustainable for you. That would be my advice actually to most founders, because a lot of the founders, because lack of awareness of that percentage or the impact on the overall profitability, they ended up spending like sweating for a full year, but not profitable, or ended up losing money. So I would say probably take more of a little bit higher kind of a higher level approach to manage your finance. Is first of all, just get a like close to 80 to 90% accurate estimate of the chargeback from the get-go, and try to bake that in and build up your pricing model, build up your profitability model, so you can be more prepared and be more aware of. On our chargeback, for example, our platform right now, we don't track the detail level, like the MCB or OI, like the detail granular Cameron you talked about. We could build that in the future, to be like the line item detail chargeback. That itself, would probably incur a lot of like input. Like we will have to have you either upload this file, from Kihi, or we would have ask some manual input, or unless we can get it electronically in the future, maybe from Kihi or from Unify directly, we can do an API download. My way is always like for data, if we can automate, we can get it download automatically. That's the ultimate way to go. If we cannot do that today, it's gonna incur so much extra effort from both your side as well as our side. So then we have to evaluate what's the benefit of that. So I would say a hacking way to do that is, which we build into that, we ask you to, based on those paperwork, estimate the chargeback in the beginning on a monthly basis. And then our finance model would bake that into your current profitability already. So when you look at your current, the other point I want to point out, usually the chargeback comes back much later. Correct me if I'm wrong, right? They come back 3 months or 6 months, like much later in the year. So it would be really good. Again, that's where we built the feature is for the current months, we ask you to enter a percentage of the chargeback as to start with. So our aim is to shoot for 80% accuracy, give you a good idea of your profitability, both at the gross sales versus net sales, as well as the cost of goods sold, the gross margin perspective. So I think once you have that good idea, and even at that high level, you are at much more powerful level to play with your pricing in your negotiation. For example, the shipping fee is the same idea actually. So I would advocate to go for the similar idea. I understand like with inflation, all those like shipping fee also changes so much. So it would be really good actually to do those kind of estimate. And then when you enter the actual, we can always reconcile for you. And then it's clear you can see a difference. And then in the future, you can adjust your estimate. And then you can adjust your pricing, can adjust your overall profitability model accordingly. So I would say that's kind of our way of hacking the way of doing a better finance management. I hope that helps.
I just wanted to jump in to say that, scan backs are always going to be the least expensive. And then you can follow what comes through the register, if you can do that through a retailer.
Exactly. Yeah.
Quick question, Jane, is if you do a scan back and you're not actively also running an OI, doesn't KeHE, they take 7% automatically in addition? I believe it's, I think, kind of the nuts and bolts and the
yeah, that could be, I'm not sure, to be honest, but the KeHE doesn't charge for OIs, and unless you have an ad agreement with UNFI, they do. So that's something to keep in mind. So it's
and
yeah,
the
they
OI
both
doesn't always make it to the retailer, right?
Well,
So
what I've
that's the
heard is
downside.
that KeHE customers, if it's 15% or higher, that they have a really high percentage of customers that pass it on. And I haven't heard that on the UNFI side. That doesn't mean it's not true, but I think that's why a lot of people do the OIs maybe quarterly or a little less if you're smaller, and then add like a 5 NCB, and then it that triggers a new tag. So that's a good way to play it too for UNFI.
It's the same we just learned with KeHE from our distributors, and yeah, having to trigger it with the MCB being important.
Yeah, it's definitely tough.
And one more thing on, I don't know if UNFI is the same way because we're not in UNFI, but KeHE at least requires you to do a certain number of OIs a year to maintain a status. They have a good, better, best. And good is bad, better is okay, best is
right
where you want to try to be. And so if you don't do those, they're sort of like strong arming you into it. Otherwise, there's a lot of negative consequences. So
that's true.
These details
that's true.
It's really
it's true, but I mean, I think as a young brand, you can I would start with as little as you need to do, like 2 or 3, and then if you go up to 4. That's really the most that any distributor I've heard really expects. Then they're gonna push you into other marketing programs and advertising, but I found that KeHE on the whole is less, because they don't make you do an ad agreement and like UNFI does. They're both good. I'm not saying one's better than the other, but it seems like KeHE's more streamlined and a little bit easier and a little bit less expensive.
Yeah, Nick, it's also too, it's like if you're banking on staying with the retailer because you're participating in the OIs, like it's like if you're going to do something on the low end, just do that on the low end. And then I would just like really knock out of the park the MCVs and like just like the overall execution. Like you don't want them going to figure out like, oh, am I going to keep this brand on or off? Well, how do they participate in the OIs, right? Like you don't want that to be like the indicator of what's like making their decision. Like just show that you participated, like show good faith, but like just execute on the MCVs, like the store level promotions. Alice, you want to, I know we're getting up against a little bit. Do you want to talk a little bit about just kind of the solution you built and like kind of how people can reach you?
Sure. Yeah. I guess before I do that, I want to ask you, obviously we seems like we heavily use distributors here for this group. Are you more of a omni-channel? You sell online as well as offline, or are you pretty much all just the retail and wholesale?
I wish we had a polling feature in Zoom, but yeah, I think I know most of the brands that are on here, and I would say that most of them are omni-channel. So yeah, that's I would say like we do have a few beverage brands, and obviously beverage is much harder to grow online only. But I would say like most of the brands here are probably prioritizing retail, but have a little bit of an online presence as well.
I see. Gotcha. Okay. So, okay, I saw some responses here, 90% retail, 10%. That's probably pretty representative of this group, right? Okay. So, anyway, so I think, okay, same. Great. Thanks, Liz. Okay, I got a good sense of what this group, like your sales channel. In essence, I would say myPocketCFO, we help you again recognizing most of the young CPG brands today. Your omni-channel in nature. Some are more heavily towards online. Shopify, Amazon, some are like you guys are more, I would say, relying on the retail wholesale channel. But with myPocketCFO, the concept is from the get-go, we actually track your sales by channel. So maybe is it okay to show a quick screenshot, Amazon?
Yeah, share your screen.
Yeah, Cameron.
Yeah, you're good to share your screen.
Okay, so yeah, I will just show briefly. Okay, so I think what one feature we build in is basically from the get-go, when you get onto our platform, we actually we customize a set of chart of accounts for you. So for CPG brands specifically, we would actually have separate chart of account for your revenue level. So let me see if I could so I could not do a search, but basically for example for all your sales is sales of product, right? But for us, we actually we go by channel. So we would have sales of product Shopify channel. Actually, let me stop share because it's probably better for me to talk through. So from the get-go on the chart of accounts, when we set it up for you, we set it up by sales of product, Shopify, sales of product, Amazon, and sales of product invoices. If you want to go down to even more detailed level, let's say sales of product by Kihi, sales of product by Unify, we can do that as well. We think this is really important. Finance or accounting, in essence, in my view, is business owners' view of what to track in whatever happens in the real world. So and that's why we build specifically for CPG brands, is we think to know your sales across channels or across key distributors is a key to start with. So just from the get-go, we have those mappings for you. And because we do your bookkeeping automatically using our software, we actually identified the mapping between, let's say, vendor name and the transactions. So if whenever we see a, let's say, invoice to Kihi or Unify, we automatically actually categorize that into the channel specific sales for you. And we also calculate cost of goods sold accordingly by either the channel or by the key distributor you have defined through your chart of account. I would say from the get-go, like from the gross sales level, you are it's across channel, it's consolidated, but also across the channel, right? Okay. Anyway, I was just there's some comments there, and then we also track chargebacks by each retailer. I would say at this point of time, again, we don't have the detailed breakdown of those chargebacks. We ask you take more of a, I would say, finance hacking approach. We ask you to estimate percentage so we could automatically apply on a monthly basis, and then either every quarterly, we do a reconciliation against the actual chargeback you receive. We actually have a feature where you enter the actual chargeback. We can certainly build into to have a more detailed line item by line item chargeback by each distributor. So that's where, from finance management perspective, we do quarterly, we call true up or quarterly reconciliation between the estimated chargeback and the actual chargeback. And we can tell you the differences. Like if we keep running this for a quarter or two, we pretty much have a pretty good idea, in terms of either Kiki or Unify, what's their chargeback level. Of course, then when we have the detailed item, and then if we can track them month over month or quarter over quarter, I think over time you would have much better idea, and then you can maybe start, doing some analysis and go back to the distributors for either claim back or detailed discussion. So that's I would say on the high level how we treat the rev rec. The other thing is we automatically obviously take the reconciliation between your cash account and your accrual sales. So whenever you issue invoice, we record that automatically as a gross sales, accrued gross sales. And then when they pays back you, let's say you have 10K, PO or invoice, but they pay back 3 months later. So what we would do is we first of all estimate chargeback. So you enter estimate number, and then we automatically calculate on like the current month, November level, what's your gross sales, what's your estimated chargeback, and what's your net sales level. So you have I would say again, almost near time, but 80% accurate idea of what's your chargeback, what's your profitability level. And then on a quarterly basis, we figure out a cadence whenever they pay you and whenever they deduct the chargeback. Maybe some of those may take 6 months to a year. I know it's kind of a complicated process, right, for them to do the chargeback. But anyway, if we keep running it, then we let's say we do a quarterly true up with the actual chargeback number you get from those distributors, then we automatically calculate the differences between the actual number and the estimated number, and then we automatically do a true up for you on a quarterly basis. That's I would say, and then again we can do it from the get-go at the channel level, and then we can do it at specific distributor level. So I'm gonna pause here and see if there's any questions or comments.
Alice, I was gonna chime in really quickly. Sorry, I've been here just off video. My Zoom is glitching. So the two other things that I wanted to mention, at least the two things that I've found the most helpful, especially as we now have onboarded into several distributors, is the other thing that I was having the biggest challenge with in QBO and in QuickBooks was really being able to create different charts of accounts. And that's been the challenge. Like a lot of my colleagues that I talk to have no idea how much they're spending on samples, have no idea how much they're spending on merchandising and trade spend. So like what I've been able to do that's helped us tremendously through myPocketCFO is literally break down, and this is where we've been able to get super granular. And I've gone to Eric, the myPocketCFO controller, to be like, I need this account, right? I need to know that like what I'm spending on trade spend versus what I'm spending approximately on samples. Every single time we do a demo, you know, every single time I have a merchandiser go into the store, and what's that hourly rate? So like we're able to really break that down and customize it to our myPocketCFO account. And so you can, whatever, you know, is custom to your business, right? It's really easy to create those charts of accounts, which was very challenging for me to do in QuickBooks because I had no idea if I was doing it correctly or not. And then just the functionality is just, it's not from a founder's perspective, it's more from an accountant's perspective. So QuickBooks is not my favorite tool to use. And then the other thing is, you know, being able to see my cash flow at a glance has been just crazy mind-blowing, because that's just not something I was able to do prior to myPocketCFO. As I was kind of guessing, like, okay, I'm thinking UNFI is going to pay me at this time. Like Pod Foods is very reliable. I know I'm getting paid on the 10th of every single month. I just got paid. So it's very simple. I can go and take a look at my chargebacks. Highly recommend Pod Foods. We've had a really great experience, even though it's on consignment. It's been actually really amazing to work with them. And just easier to break down what those chargebacks look like. But going into myPocketCFO every single day, I'm able to see like, okay, this is how much cash we have in the bank. This is when we're going to get paid by this distributor. Approximately, this is how many chargebacks I'm going to, you know, incur. And then this is what I think I'm going to have at the end of the day in 3 months. So that's been, I think, the two major features, especially as we grow further into retail, that have just been a game changer. Like I was spending, we launched into Central Market with UNFI. I was spending so much on trade spend in the beginning. I'm like, sure, I can do these 20 demos. And we were about to launch, right? So I was like, okay, let me do a lot of demos. And then I'm realizing how much money, I mean, it's, you know, the first 2 months we were losing money, and I was able to see that so clearly. So, and then I see, Jane, I'll answer you directly, but yeah, I mean, I'm loving Pod Foods as a distributor. They're really easy to work with. So that's just, if anyone has questions about Pod, we are now in 1, 2, 3, 4, I think four of their DCs. So those are my 2 cents.
Do you also use direct or just the warehouses now?
We do. We see most of our sales come through Express, through the warehouses.
Okay. Thank you.
Thanks, Ash, for sharing our experience. Actually,
yeah, absolutely.
Yeah, I want to add on that. We also, out of the box, we show you your trailing 12 months, month over month cash flow situation. So we show your month over month cash inflow, cash outflow, and your net cash burn out of the box. So whenever you log onto that on a daily basis, you can pretty much see, you know, like in the past 12 months, are you cash negative, like net burn negative on a month by month basis, or cash burn positive? Again, I think those are just some of the fundamental financial metrics I would advise a founder to keep that first, be aware, and then keep that in mind. And once you have that knowledge, you can easily in your operations like adjust pricing or negotiate with your wholesaler, retailer, or just tweak your operations.
Awesome. Well, we are up against it.
A couple of questions. Oh, sorry.
Sorry, no worries. We have time for one question.
Okay. Just quickly, are you lumping all chargebacks together, or are you breaking out at least by what I would say is a marketing expense versus transportation or shipping expense?
So we are breaking it out by pure fee, chargeback, and marketing expenses. So marketing expense will actually go into the operating expense category.
Right.
The pure chargeback would go into the fee, would be gross.
Okay. And then shipping would go into transportation.
Yes.
Okay. Just want to make that clear. And then can you talk briefly to the complexity if you're already on QuickBooks? Is there a simple way to move to your platform?
And a simple way we have done with many of our customers is, if you choose to have myPocketCFO manage your historical data, let's say today is November, you said, hey, I want you to scrub my like January to date data, we would ask you to open a new QBO, because we write journal entries into QuickBooks. We don't want to mess up with your old book. We still want you to keep a record of that. So simple way to transition to us is open a new QuickBook. And once we plug into your commerce, your invoicing, your banking and the new QBO, we start process, because it's software. It doesn't take us much extra effort. We basically plug into the new QBO, we insert the specific chart of accounts for you. And then we start posting, we start mapping, categorize, and posting all those transactions into this new QBO. Typically, I would say it takes, within 2 to 4 weeks, we get that all set up done. We have you review, sign off, and then we also get anything, the product customer list migrated. We will take care of that. Once that's done, and you can, our recommendation is you can shut down the old QBO. You can archive all the data. I believe the archive will be accessible for you for 2 years. So you can always have access to, but then you basically start using this new QBO with myPocketCFO. Does that answer your question?
Yeah. Yep. Thank you.
Awesome. Well, thank you so much, Alice, for hosting this today. I will personally introduce everybody who's on the call to Alice after this. And if you have any questions or want to learn more about her platform, you can kind of take it offline there. And Alice, thanks so much. And thanks to everybody who joined us, and have a great rest of your Thursday.
Thanks, Cameron. Thanks,
Thank you.
everyone.
Thanks, everyone.
Bye.
Bye.